This is a continuation of Lecture 10 on Chapter 10. By the way, quick side note, I had some complaints about the poor video quality, and I didn't really know how to fix it, but I think I may have figured out how to upload at a higher resolution to YouTube. So I'm hoping, unfortunately the semester is almost over now, but I'm hoping these last couple lectures you're able to see a little bit better. If not, hopefully it's no worse. Let me know if it is. But anyways, in the very end of the last lecture we were covering how to measure the cost of equity when making what we call the WACC, the weighted average cost of capital. We looked at the discounted cash flow approach, which is the same, if I scroll down here, the same formula as we saw in the last chapter, expected returns on the equity or the dividend yield plus growth rate, and then we found it to be 13.06%. Now we're going to do the other two methods. So a couple chapters ago in the risk and return chapter we learned about the capital asset pricing model, the CAPM. It says the return on equity should be the risk-free rate plus beta times the return on the market minus the risk-free rate. We're going to go ahead and estimate what all these inputs should be. The risk-free rate is fairly easy to find. There's a couple choices you can use for that. Some people like to use the short-term risk-free rate. Some people like to use long-term government rates. My personal preference is to use short-term, so that's what I picked out here, which is very, very low rates right now. Short-term U.S. Treasuries are 0.08%. Then let's return on the market. I used 8.91%. Where did I get that from? I have a chart over here. This is the U.S. stock market returns going back to 1871, so it's a very, very long time period. And then I've just fit a straight line to it. So this is about the simplest way you could measure expected return on the market. You could certainly come up with a more sophisticated econometrical model to figure out what the expected return on the overall market is. But long-term expected return has been, this red line slopes at 8.91% a year. So that's what I'm going to use just to keep things simple. And then we need Coca-Cola's beta. There's lots of different financial service providers that estimate betas, and I went out and looked at a couple of them, Value Line and then S&P Capital IQ, and they were both about the same, which was about 0.5. I ended up on here using S&P Capital IQs, but different places will come up with different estimates, or we could have estimated ourselves too, but we would have had to make certain assumptions, like over what time frame are we going to measure beta, are we going to use daily, weekly, monthly returns, and so forth. So you get slightly different answers. But that's a fairly low beta. Remember, 1 is the beta of the market, 0 is beta of the risk-free. So this means they're half as risky as the market, roughly. And if you plug all these numbers in, so 0.08% for risk-free, 0.5078 for beta, 8.91% market, and so forth, you get 4.56%, which is way different than we got. We got 13.06 using the discounted cash flow approach. CAPM is notorious for being, it doesn't always give you the same results. I mean, it sometimes gives you very wrong results. For example, in this case, the dividend yield itself, not considering any capital gains you would get on Coca-Cola, is about 2.5 to 3%. So that means this is only accounting for about 2% capital gains, which would mean you'd expect the dividends of Coke to grow at about 2%. And we've seen in the past their dividends have grown over 10%, and even if they only grew at 5%, at some point the stock price would have to catch up, or the dividend yield would get absurdly high and people would buy the stock. So if the dividends are going to grow at 7% in the future, and that's a lowball estimate, it's really hard to believe that the stock could only return 4.56. So CAPM is really not that old a model. It was just started being used in the 80s. The theory behind it's sound at all, the diversification theory and everything, but it's not very practical yet at the moment, and a lot of it has to do with these inputs. We're not real sure how to measure expected return on the market. We're not correct on how to measure beta. One thing that researchers are doing now is trying to measure time-varying betas and things like that. And I do think maybe in the future CAPM will be more applicable At the moment, it's just a little too sketchy. It doesn't always come up with consistent results. So between those two models, if I was picking, I would definitely go with the discounted cash flow approach. But I could definitely throw a problem at you on a quiz or a test where I give you these inputs and you need to use these to calculate the cost of equity. Okay. All right, let's move on to the last approach, the bond yield plus risk premium approach. This one's also fairly sketchy in that we don't really know how to come up with the risk premium. So the formula says the expected return on the equity, or the cost of equity for us. If we issue equity, how much do we have to pay as an interest rate to the people who buy that equity? Is usually the rate on your bonds, which was 2.25% for us. If we go back up, we in the prior lecture or prior video, we calculated the return on our bonds to be 2.25%. And then you need to add some risk premium. Where do you get that risk premium? Well, the capital asset pricing model is one model to figure out what a risk premium should be. Your book suggests for this particular model to use 3 to 5%, and then it goes on to use 4% in the examples it does. So that's what I've used here, and you get 6.25% when you add them together, which is still fairly low. It's better than the CAPM estimate, but it's still fairly low, again considering you're getting almost 3% dividend yield alone. So that's suggesting that your capital gains for the long run are only going to be a little over 3%, which if you look at the past dividend growth of Coca-Cola, that's probably too low. So your last step actually is to take all three of these and then try to average them or something. In an ideal world, all three of these approaches would come up with the same results. We have very widely ranging results from 4.5% up to 13%. I'm going to go ahead and use this one just because it's, just from past experience, the most stable method to measure expected returns on equity and cost of equity. So we're going to go on now. We've measured our cost of debt. It was 1.7 something percent. We've measured our cost of equity. It's 13.06%. Now we just need to do a weighted average of them. So last thing we're going to do is our weighted average cost of capital, which is this formula I showed you way back at the beginning of the last video. I've gone ahead and plugged in my cost of debt, after-tax cost of debt. So again, we multiplied it by 1 minus t, but we got 1.71%. Our cost of equity, we're going to use the discounted cash flow approach, which is 13.06, which I think is the most realistic of the three. And then the last thing we're missing is the weights. And again, these have to add up to 1. It's the percent of our capital, of our assets, how we raised it. How much did we issue debt to buy our assets? How much did we issue equity? There's 3 ways you can do these weights. One's called book value, which is you use the amount listed on the balance sheet for debt and equity. Those are sometimes, we call them historical weights, because it's based on how much they issued in the past. Another way is to do market value, which is you use what the market value of the total debt and equity of the firm is, meaning the book value per share might only be, for Coke, something on the order of $20, but that doesn't mean they're selling for $20. In fact, most companies are going to sell at a premium to their book value, so that per share price might be closer to $35. I think it was 36 or something. And so then if you take that times the number of shares, well, that's the total market value of equity. We call it the market cap. So when you're calculating what percentage of our firm is in debt versus equity, you could either, these first two are usually what you have to decide between. The ideal choice would actually be what we call target weights, which is you'd like to know what the firm wants their weights to be. But you usually don't know that because most firms don't report that in the annual report. So the only way you're going to know that is if you're the guy running the firm, and then that's great. Use your target weights. But if you're an outside analyst or anybody that's doesn't know the target weight of debt to equity that the firm would like to have, well, then you have to choose between book and market, and the typical choice is to use market value weights. So I'm not going to make you calculate those weights. They'll always just be given to you. I just wanted to real quick touch on that there's different choices of how to come up with those weights. So to do an example, say Coca-Cola's target capital structure. I'm going to actually give you targets. So let's say we work for Target and we actually know that their CFO has chosen, in order to optimize their capital structure, they want to have 9% debt, and 91% equity. And I actually pulled these as market value weights. I went and looked at their current stock price and I used book value of debt and market value of equity, which is actually the standard way most people do things in practice. It's hard to get market values of debt, but this typical way that's actually done in practice is you use book value of debt, market value of equity. But that's maybe a little too much information, too much detail. But let's say that this is the correct weights that Coca-Cola wants to use for their debt and equity. Now you want to calculate your weighted average. You plug in, and this is just the same formula from up here. We've brought the 1.71% down, we've brought the 13.06% down, and then we've plugged our weights in there, which I didn't put as percents because then it get a little confusing. I put them in as decimals. So we have our basically 9%, or 0.09 is our weight we're putting on debt times the cost of debt plus the weight we're putting on equity times the cost of equity. Again, these weights have to add to 1. They do, that's correct. And when you run the formula, you get 12.04%. Alright, so that's it for this chapter. There'll be a quiz on this chapter. There was a quiz on the last chapter on stocks. And then we have one more chapter, and that'll be it for this semester. So I will try to have this last chapter's video up, chapter 11. Well, we have the time difference, which makes it confusing, but it'll be up worst case scenario Friday morning for you, but it should be up tomorrow afternoon. So thank you. Send me an emails if you have any questions. Thanks.